You only have one life to live, so get the most out of it. On Good Life, Great Life, join me, Brian Highfield, and my guests as we share success stories, habits, mindsets, and lessons learned by successful people. These lessons are not taught in schools, but are critical for getting ahead in life. Whether you want a successful business or career, optimal health, or a lifestyle that most people just dream of, Good Life, Great Life has you covered. After retiring from a successful corporate career in my 40s, I founded multi-million-dollar businesses in the sports and healthcare arenas. Now, I help everyday people maximize their lives and speak regularly at seminars, on podcasts, and radio shows to share principles on the topics of health, wealth, and happiness. Don't let a good life get in the way of a great life. Join me today on Good Life, Great Life. Well, welcome to another episode of Good Life, Great Life. In today's episode, we have Rick Batenburg III, and Rick is a former Merril Lynch financial advisor, but the current founder and chief investment officer of the tech venture capital and consulting firm Cliintel Capital. Welcome to the program, Rick.
Thank you so much for having me on. I really appreciate it.
Absolutely. And our audience wants to get to know you and what you're all about a little bit. So can you describe for us what Cliintel does and your involvement?
Sure. So Cliintel was founded in 2015, and it was really a response to really the capital inefficiency I saw in cannabis at the time. Really what we do here is we find companies and or founders that we feel like meet certain criteria that we're looking for. We kind of have an ethos of, you bet on the person, not the deal, because the deal can change. But the person that you bet on, they can find a way to navigate those problems. So, we look for really anything that we think is clever, that has a what we would describe as an asymmetrical risk to return profile, meaning that we think that the risk outweighs the reward outweighs the risk considerably. And that can be for a variety of reasons, but by evaluating the deals through a little bit of a different lens than less of a traditional kind of analyst approach, it allows us to identify opportunities that maybe other people have missed. So I like to say we put the people, ideas, and resources together to create value for the stakeholders, for the employees, and for the customers. So when you can do that, it's really quite magical. You can put together something that benefits everyone involved. So, I like to think of venture capital kind of the central ignition point to, the conglomeration of the people, ideas, and resources. So the ability to put those pieces together in a way that is fundable or able to grow or able to, be exited through, traditional corporate governance and capital strategy. So what we do really is, we'll find a deal or an idea or a company that we think has a strategic position in the context of whatever its addressable market is, and then make sure that they look and feel and taste like a company that can be scaled and, funded and invested in and grown and eventually exited. And that comes in a variety of, for lack of a better term, I'm going to call services. So, whether that's making sure their deck's correct, the data room's correct, making sure that their corporate governance is correct, the capital instruments they're using to fund the company are correct. They have the right type of investors, they have the right type of advisors, they got the right type of board of directors, and they have the right type of executive team that is able to scale that business. And that's really where our value add comes in beyond the capital, is making sure that they look and feel and taste like a company that can take on that type of funding and handle growth.
So for our audience that isn't aware, how does the venture capital model work just in general?
Sure. So venture capital differs from private equity in one real main way, which is in venture, we're earlier and we're looking for a higher return. So generally private equity is going to take a private position into a company that's kind of already cash flowing or already has a tremendous amount of revenue. And venture, we'll do everything from just an idea to, kind of a nascent pre-revenue business or, even just a small growing, a business. So really the only difference between private equity and venture is the size is really the truth. But in venture, we're looking for a 10X, meaning I want 10 times on my money, which means that generally you're very early in the process, which is really where I find I have the most fun. is kind of helping them build that growth. So in venture capital, we take a private position into a privately traded company traditionally, and kind of help that company scale. And so we'll use a variety of financial instruments to accomplish that are in the best interest of both the company and the investors. And in venture capital, traditionally, we will have a venture fund, and that fund, I have private investors that have invested into that fund, and then the fund makes an investment into the target assets or the companies we're talking about, and manages that investment on behalf of the venture fund. And so we have a venture fund. It's our fourth fund here in the last, I guess, 8 years now. And that fund takes strategic positions into private companies. And that's kind of the crux of it. And then the fund gets the return, and then the fund returns the capital to the investors that are holding assets in that fund.
So how do you, and you touched on this a little bit, but really, how do you find these companies to invest in? Where do you look for them?
So the key really in venture capital to sourcing deal flow is you have to develop a network of other people that are in the deal making business, that are in the entrepreneurial, in that space, that you have a relationship with, that know what to bring you. And that's really the key. So, you can always source deals traditionally, like looking on, analyst reports, or looking on, whatever it may be. There's plenty of tools out there that you could source deals. But the best deals are generally the ones that never make it to those lists, right? The best deals are the ones that my buddy calls me and goes, hey, I got something for you. And that really comes with just years of, making sure that you're constantly available. And, I have a policy that I always take the meeting, because I can tell you how often somebody walks into my office that they think they've got one thing, but, they don't have quite got it. But if we add this one, this other company, and we combine it with this, and they think of it a different way, then all of a sudden, now I'm looking at a deal nobody else has looked at, simply because it wasn't put together that way. So, being open to, even if something on its face doesn't look quite like you want it to, I kind of have a policy. I'll give anybody 15 minutes so that, maybe they just don't know how to articulate the deal in a way that makes sense, or maybe they're not thinking of it the right way. But because I have a lot of experience over the last, my lifetime of kind of being in that position and hearing from a lot of entrepreneurs, the diversity of skill set and information that I have, simply by hearing so many deals, allows me to contextualize the deals within a larger macroeconomic market, that I might hear something that somebody else doesn't, because they don't have the same contextual information. So everybody's skill set's different. Everyone's, experience is different, which means that you've got a different contextual information. So your ability to evaluate a deal is contingent on, how much information you have to compare it against. So, like anything else, the longer you do it, the easier it gets and the faster you can do it. So sourcing deal flow for me is all about, I have strategic partners and friends and mentors and other investors that they know what to bring me, because it fits the ethos of kind of what we do. So that's the best way to get deals, obviously, is because they're kind of pre-vetted by somebody that I know and trust. And, but deals can come to you all kinds of different ways. The key is being open and being willing to listen.
Yeah, I really like that networking aspect of it. It's really about your network and people, relationships you build, and people you trust, and they kind of know what to look for and do that. And I also like what you said, just being open-minded about that. You have this 15-minute policy. You'll listen to, almost any idea that someone brings to you. You give them 15 minutes to evaluate it, because I think there's probably been a lot of great deals that have been thrown away because, the cover of the book didn't look so good.
You know what? And it's really interesting, because there's a very traditional way of evaluating business opportunity that has to do with, you evaluate the overall market of whatever addressable market they're after, and what is the, diligence baseline for what a company in that space and that, part of the supply chain can and should do. What's the opportunity? Can you arbitrage the opportunity? And it's a very kind of sterile evaluation of a market position and the company itself. In venture, we have less of that as a kind of a benchmark, simply because you might be looking at companies that, I call them French paintings, right? They're worth what somebody will pay, because there's no anything to multiply their revenue by, because if they're revenue, right? So your evaluation has to become a lot less quantitative and more qualitative, so that and that's in my opinion where you kind of find the value in venture, is you're evaluating qualitative attributes of a company, whether that be the strength of the CEO, or its strategic position within the context of the market, or there's other things you can look at that are less quantifiable, and I think that that's really where we as a venture firm excel, is evaluating human beings and their potential. So really understanding, and I meant what I said, you bet on the person, not the deal, because the deal will change. The deal always changes, especially.
Yeah. And that seems like the approach from oh gosh, what's the show on CNBC?
Shark Tank.
Shark Tank. Yeah. So they're always evaluating the person. I think they put the value of the person presenting the deal as much as the company itself.
Absolutely. And so kind of my three benchmarks when I'm looking at leaders and CEOs is, one, they have to be emotionally connected to the success or failure of the company. Two, they have to really understand their numbers, meaning they need to understand down to the nth degree how they make money. And then three is, what they really have to be able to either really understand everyone's job in the company, or be able to do everybody's job in the company. And the reason for that is, especially in startup mode, lean startup mode, you lose somebody, or somebody's sick, or whatever it might be. But if the CEO is able to go in there and fill those gaps, and they're emotionally connected to the success or failure of the company, the progress won't stop, even if you're having trouble with whatever it might be, some technical component of what you're doing. So I really like CEOs that have a specific skill set in the industry that they're going into. So, I can teach somebody how to be a CEO. I can't teach them, molecular biology to do a biotech deal, right? So, being a CEO is, I think, a skill set that can be learned. Whereas if you've got specific tribal expertise into a market, not only are you going to understand the macroeconomics of applying that to your business itself, but you're also going to be able to step in and kind of bridge gaps where traditionally, if you're a CEO that's not a doctor and you want to do a biotech company and you don't understand the technical components and you have to hire somebody from outside, and you got it's a bigger expense. You don't know if they're right or not. So those are kind of my three first benchmarks. So like, you got to be this tall to ride. Mm-hmm. And if you don't have one of those three things, it's very unlikely that it's a much longer road for us to kind of get involved.
Yeah.
But I guess that is a little qualitative, but I mean, at the same time, it's more, your impression of this CEO and the leader and the person that's asking for your help.
Yeah. So you mentioned, like, knowing your numbers, how to the nth degree, how they're making money, knowing employees' jobs. So what else for a startup or someone who's got a business up and running, what else do they need to really keep in mind if they want to look to venture capital or to raise capital, because they have these big plans to really grow that business?
Sure. So I think a common mistake that I see a lot is that new companies will come to venture or investors with a really strict idea of what the financing needs to look like, meaning they'll come with an existing financial instrument, whether that's a equity raise or a safe note or whatever it might be. And that's a mistake, especially coming to somebody like myself or a venture firm, is because we're going to want to design a financial instrument that makes sense for both our fund and for the company itself. So a common mistake I see is bad capital strategy. And this happens especially with the type of CEO that I described that I like, is because they weren't finance guys, right? So I've seen this 150 million times. Is that a good company that checks all those boxes, uses the wrong financial instrument, or they raise too much money too soon, they give away too much of the company, and then they end up hamstringing themselves because they don't have control of the equity anymore, or they've got high interest debt that they can't move forward. And then they end up ruling by committee of this investor group that, has different opinions on what's going on and what's supposed to go down. So, scaling your expectations back on how much capital you need, you really want to go strategically and go, okay, what's my company really worth today? Not, I want money based on future earnings. Go, okay, what's my company worth today? How much am I willing to give up? And my rule of thumb is 20% of what the company's worth is what you should be looking at in equity. So if your company's worth $1 million, what can you do with 200,000? Okay. So, and what benchmark does that 200,000 get to you where you can raise the valuation again? Right. So you don't need to raise money we got 15 checkpoints that we're going to hit here in between the next 24 months. And we need $10 million to do it. Well, your company's worth $1 million, right? So what are you doing, right? There's no reason to raise that much money. You want to go, okay, we want to scale how much money we need based off of, future checkpoints, right? And so it's much simpler, or not simpler necessarily, but what you want to go into a pitch with is you sell them on the vision, right? You don't have to sell them on the financial instrument. You don't got to tell them, oh, well, we want this valuation at this price, right? No, sell them on, here's how we're getting from here to there, right? Here's what's going to happen, right? Here's the benchmarks that we think we can hit. Here's the check marks that increase the enterprise value of our company. And then you can reverse engineer a financial instrument with an expert, that is vested in now in your success, where you can tranche the investment, right? Or if you go to a good partner, they go, okay, well, we give you 2 million now. And if you hit this benchmark, we'll give you another 2 million. And if you hit this benchmark, you give another 2 million. And that is really how you want to come to investors, because you don't need to sell them on the financial instrument. You need to sell them on the vision of what you're trying to accomplish, and then tell them how much money you need to hit each benchmark, right? And that's how you negotiate the deal. And then you'll come up with the financial instrument. You don't have to go with an offering.
Yeah, it's funny because it reminds me of a story of a CEO I know. He went into a meeting with some equity to get some equity to partner some investors to invest. And he was talking about all financials first. And then midway through his presentation, he then shared the vision, which was, we have the only natural product ever proven to extend lifespan. And every hand in the room went up and said, why did you start off with that? Why did you bury that in the middle of your presentation?
So that actually brings me to another point, which is, there's been a couple deals that I've done, and specifically this is legal gambling space that I did about a year ago. That I sit on the board of this company, and for legal purposes, I'm not going to disclose what the company is, but you'll be finding out very soon how cool this is. But the point of it is that when I got pitched this deal from a friend who'd put in like $500,000 into this deal, he's a doctor, he's not a investment guy, he's a his MD, unbelievable surgeon, one of the best in the world in his particular field. And he's like, hey, I put $500,000 in this deal, will you look at it for me? And I'm like, sure, but let's do this in reverse next time.
Yeah.
But I start looking at this deal, and I'm like, holy shit, this thing's got some legs, and obviously I kind of come to deals like that where I'm like, okay, I'm looking for the other shoe, right? I'm like, okay,
it sounds too good to be true.
There's something goofy. Yeah. And generally my process, especially when I'm doing diligence, is I will bring in either strategic investors that I know have a specific expertise in the industry that we're looking at, and kind of just get their opinion. What do you think of this? What's wrong with this? Blah, blah, blah. And the first person I brought it to was somebody who had industry expertise in this specific field, and not only wrote a check, but wanted a board seat. And I was like, okay, well, I better start paying attention to this.
Yeah.
As I'm talking to the CEO, who was a Brooklyn cop for 20 years, and then for 10 years, owned bars and restaurants and ATMs. But he sounds like a Brooklyn cop, right?
Yeah.
So, and him describing what this is, it sounds like bluster, it sounds, because he looks and he sounds like a Brooklyn cop. So, I think that the reason this deal ever even made it to my desk, because I'm a small shop comparatively to, some of these other big VCs. And I was like, the only reason it made it to me is because he didn't sound convincing, right? He didn't sound like he got it. He didn't sound like a CEO, didn't sound like a startup guy, didn't sound like he had any business being in what he had. And once you kind of got past that, and this is what I'm talking about, the non-quantitative evaluation of an opportunity, is that because he just couldn't articulate the deal in a way that made sense to somebody like me. And so once I was able to really dig in and kind of, put a sport coat on him and pick the deal for him, all of a sudden funded, like I had it 100% funded in 2 months. And so that was sort of interesting to me, is that the ability to tell a story is really important, especially if you're a pre-revenue company. If you're brand new, you got to be able to sell the vision. You got to be, the guy. And if you're not the guy, you need to find somebody to be the guy who can tell the story. Because we as human beings in general, we learn through anecdotes. We learn through anthology. That's just how it's just a part of our nature, is that we want to be told a story that we understand and can connect to. And especially if there's no real financials associated with this, if it's all just, these are all guesses, you better be a, persuasive and convincing leader. So I think that that's like an important component to leadership in general, is your ability to tell the story and inspire leadership, because you need people to follow you, especially in a
if you can't share that vision, no one's going to see it and no one's going to follow you.
Well, exactly. And luckily, I have sort of made a business out of comprehension, and trying to be able to look past the face value of an opportunity and identify, asymmetrical risk to return profiles simply based off of the human beings. And don't get me wrong, I've made mistakes, certainly. But, fastest way to know whether you can trust somebody is to trust them, right?
Yeah. Go back for us a little bit and talk about the transition for you personally from being a financial advisor and then becoming the chief investment officer and starting up Cliintel Capital.
Sure. So when I was at Merril Lynch, I had a very senior partner, and I did about 203 transactions on the buy side of IPOs and new issues. So, where there's an IPO or a company's issuing new stock, I was in there at 5:30 a.m. doing the actual ordering of those stocks into my portfolio. We had 100% of the allocation for Colorado. So I did a lot of those transactions, which meant that I was reading a lot of prospectuses of these companies, because I had then had to turn around and parrot it to, in an abbreviated fashion, to my high net worth investors that were buying these IPOs or new issues. So really the crux of why I was like, okay, I don't like this anymore, is one, I didn't like the correlation without causation, meaning, you're picking stocks, but you don't really have any influence over whether those companies are going to be successful or not, which means that I didn't feel good about picking a stock and then hoping, I didn't feel like that was authentic to who I am and my investors that had capital with me. I didn't like it. It felt bad, especially when there'd be some macroeconomic movement that would affect the portfolio. And I remember specifically, I held a lot of Apple stock at the time, and Tim Cook came out as gay at the time, and the Apple stock took a hit. And I had some conservative clients that were calling me, yelling at me, and it really upset me. I was like, I don't think I want to do this.
Yeah.
And right around the same time, I started bringing in more private equity, like approved private equity deals that were approved by Merril Lynch, and I had a group called the Abraj Group come in from Dubai and London and New York. And it was this female and male guy that came in from, I think she was from New York and he was from London, and they were flying through to pitch a private equity deal out of Abraj Group to my client. And I remember the pitch. It was so cool. It was, they were consolidating dairy farms. So when a country moves from third world to second world, or second world to first world, from 3 to 2, they start consuming more dairy. From 2 to 1, they start consuming more meat. So what they were doing is they were going into Africa. They were buying up, independent dairy farms, consolidating them, putting in their own management, reducing redundancies, and they were just crushing this private equity route between 18 and 30% IRR. But what I remembered amongst the deal, which is just stuck in my brain, because I remember it being like a eureka moment for me, like, oh, this is what I want to be doing. This is way cool. And they were well dressed, and they were drinking, and they spoke 3 languages, and they weren't even staying there tonight. They were flying through Denver to LA. They were like in to pitch my clients and headed back to the airport. And I was like, okay, this seems like more like what I want to do.
Yeah.
When I grew up, my father's an entrepreneur. And so, I grew up reading P&L since I was 4. And so it was a natural transition. And part of it was, I noticed a capital inefficiency in the Colorado market, and I happened to be in Colorado. My father had already made some passive investments into cannabis. And I was like, well, I bet you, because the rules from the Marijuana Enforcement Division at the time were you had to be a 2-year Colorado resident to invest into cannabis. And so at the time, there was no rules around this. I just guessed. I was like, I'll bet you if I create a blind pool fund that the investors have no say over the discretion of the assets, that they will allow me to have outside investors. And this was just a guess. And so I was working at this structure for a couple months, maybe longer. And I've got a few great mentors, but one of them is Heather Potters, who she was Ernst & Young's Person of the Year twice, then a hedge fund manager. Now she's CEO of a company called PharmaJet. And, I drove up to her office, and like in between meetings in 45 minutes, she's like, oh yeah, just do it like this, and that became the basis of me leaving Merril Lynch, was this fund that became the first qualified institutional fund in the United States to hold a license inside of a venture fund based on the structure. And so what that gave me was a very flexible funding instrument to kind of allocate across the supply chain of cannabis, from grow, extraction, dispensary, packaging, hardware, compliance, training, leasing, everything. And the point of that was to develop a diligence baseline on cannabis supply chain to go, okay, well, where in the supply chain do we really want to be and allocate our most, time, effort, attention? And the reason for that was because there was no diligence baseline, that it didn't exist, right? Nobody had done the business long enough for us to go, okay, well, this is what this business should be doing. This is where, right? So we started to go, okay, what's going to be the most important thing in 20 years, right? And kind of where we landed was, okay, you don't really want to own the farm growing the grain for the gray goose. You don't really want to own the liquor store only as geographic loyalty. You really want to own the brand and the distribution. And then outside of that, you're going, okay, well, ancillary to cannabis, I don't really like ancillary to cannabis, and not, I think it was a common mistake, especially over the last 7 years, that people thought that there was less risk involved with an ancillary business that was servicing cannabis. But in my opinion, you've actually just assumed all the risk of the cannabis market in general, and without the reward, right? Without the upside. So in my opinion, you created an asymmetrical risk to return profile in the negative. So we go, okay, we want to be in the brand and distribution space. And that's really what was the inciting factor for me leaving Merril Lynch, was, one, correlation without causation. I wanted to affect the outcome of those assets. And by adding, strategic and operational value to the companies that we're helping. So, if they need more money, if they need whatever it might be, at least I'm on the board and I can help them, versus me just, picking a stock and hoping.
Yeah.
So that felt more tangible, and I felt better about that when I was going to my investors going, hey, I've got this fund. I want, we're going to do this. But make no mistake, I fell flat on my face right when I left. I'd raised a lot of money at Merril. And I was like, okay, I'm gonna open this $20 million fund.
Yeah.
And oh my God, I fucking failed horribly. It's like for the first 18, almost 2 years, I raised 300 grand. And obviously it got better. It got better from there. Obviously and
that'd be scary going out there, and especially failing your first time. But I mean, obviously you were passionate enough about it to keep going and then give it another go.
Well, and part of it was just, you get better. If you don't look back at your past behavior and cringe, then you're not growing as a person, right?
Yeah.
So,
you learn from your mistakes and you do better next time.
Right. So I think to date, we've raised about 40 million. And we've been able to really grow some cool assets. The Clear Cannabis Inc. is one of the most well-known brands, the Clear, in the United States. It's sold in 9 states. Sold more vape pens under that brand than any other brand in the country. So, everything takes time, longer than I'd like, but you persevere, right?
Yeah.
Something important enough, you find a way.
Yeah. I mean, this is very interesting. I mean, there's several takeaway points here. I mean, talk about what you talked about in the beginning about, relationships and networking. I mean, that's true in really any business, and especially yours. The merit of the person being just as valuable as the merit of the business itself. And again, I learned that from Shark Tank, right? And then what you talked about, you have to be able to communicate the vision. Otherwise, you're not going to have any followers. And those are 3 big takeaway points for me. I know we're running out of time, but
I got all the time you want. I'm good till 2:00. So I didn't.
Yeah. I want to know how our audience can connect with you, or how they can get to know you, or learn more about Cliintel Capital.
Sure. Clientelcapital.com is obviously a great starting point. LinkedIn is a great starting point if you're just looking for me on LinkedIn. And then, Frank, I do a lot of interviews. So, you can just Google my name. You'll find a lot of information on past interviews I've done over the last, 8 years or so. But, Cliintel, CLIINTEL capital.com. And then, you can find kind of with us on LinkedIn. But, frankly, they can go through your show. If I'm sure you'll have my information.
Yeah, we'll definitely have the links there next to the show. So awesome. So our guest today has been Rick Batenburg. Rick is the founder and chief investment officer of Cliintel Capital, which is a tech venture capital and consulting firm. So Rick, thank you so much. This has been an awesome interview.
Hey, it's sincerely my pleasure. I really appreciate it. You're a great interview. I'm really grateful to be on the show.
All right. Well, thank you again.